today we're going to focus on money management, and this is a real important part of the overall success of the advisory service. The money management is just as important as the strategies and your timing of when you enter and exit trades. And it's been a big part of our success in producing consistent returns in the inner circle. And the overall goals of the money management guidelines are to maintain a 3-to-1 or higher profit to loss ratio, and we'll talk about that in a minute. And the other goal, of course, is to produce consistent monthly returns. And we have been able to do that with the Inner Circle Advisory, and ultimately that's the overall goal of the money management guidelines that we use. So the whole goal is to produce consistent monthly returns. And here's a snapshot of the closed trades from last month. And we had total profits last month of $37,430, average return of 31.9%. So one of the goals, money management goals, is to maintain a 3-to-1 or better profit to loss ratio. And the profit to loss ratio is simply calculated by dividing your profits by your losses, and it's just a simple indicator of the amount of risk with your strategy or system. And the higher that number is, the better. And as I said, we try to maintain at least a 3-to-1 or better profit to loss ratio. So with last month's trades, closed trades, we had $40,038 in profits, and we had $2,608 in losses. So if we divide these total profits by the total losses, it comes up to a profit to loss ratio of 15.3-to-1. So we had $15 of profit for each $1 of loss. So that, we met our goal of a 3-to-1 or better profit to loss ratio last month, and we did considerably better than 3-to-1. In this example, it was 15-to-1. So we like to see it at least 3-to-1, and if you can maintain a 3-to-1, then you know that you're limiting your risk, and you have a favorable profit to loss ratio. And it's just a general overall measurement of the risk of your trading system. And here's the closed trade profit results, and you can see we've been able to produce consistent monthly returns. And that's the overall goal of the money management guidelines. And we've been able to maintain a consistent monthly return using the money management guidelines that we're going to take a look at. And our money management guidelines are, the first guideline is we want to always prevent small losses from developing into large losses. And if we have a loss in a trade, if we buy a stock and that stock drops 10 to 15% below our purchase price, then we'll simply exit. And this will keep our losses to a minimum. And that's an important part of the money management guideline, because you never want a small loss to develop into a large loss. If you had a 50% loss in a stock, it would take a 100% gain in that stock just to break even. So a 100% gain could take you years to recover. So we don't want to get in that position where we allow small losses to develop into large losses, because that can really hurt your portfolio performance. And another guideline I like to use is to enter and exit trades in increments. In other words, you don't buy your whole position all at one time. Now, as a practical matter for the Inner Circle Advisory, we're not able to track purchases in increments. So we simply enter, and the entry price published in the portfolio on the website is the price at the time that the stock was trading when we issued the trade alert. So in my own trading, I like to enter in increments, 1/3 or 1/4 increments as I position into a stock, and you can certainly do the same with your own portfolio and enter any new recommendations in increments. But as I said, we can't track that. As a practical matter, we can't track that on the website. And another important part of money management is if we have a profit in a stock or an option, we'll go ahead and buy a put option to protect those profits or sell a call option. And I'll show you examples of these here in a minute. So, you know, protecting your existing profits is always an important part of this whole process. And you'll see in the new recommendations, you'll see when we have a nice profit in a stock, we'll normally go ahead and either sell a call option to create a buy right trade, or we'll buy a put option to create a married put. So that allows us, it has several advantages that we'll look at here. And also, if we have an option purchase that's profitable, we can sell a call option against that option purchase to create an option spread. Okay, and again, the stop loss guidelines will exit a stock if it trades 10 to 15% below our entry price, and with options, if the option trades 25 to 30% below our entry price, we'll simply exit. And we give options a little more leeway than stocks because they're more leveraged. And again, if you lose 50% on a trade, it would take 100% return just to break even. So you don't want to be in that position because it could take years to develop a 100% return just so you could break even. So you want to cut those losses before they develop into large losses. Another important money management guideline is never risk more than your initial investment. And all of the Inner Circle strategies and trade recommendations are what I call limited risk trades, and you can't lose more than your initial investment. You can still lose on the trade, but you won't lose more than your initial investment. And this is very important because if you ever take a trade that's not a limited risk trade and your risk is unlimited, then you risk wiping out your account if there's some unexpected event and the stock or option goes against your position. You could wipe out your account and then owe the broker money. So you don't ever want to be in that position. So we always limit our risk to our initial investment. And again, using the stops can help us maintain that 3-to-1 profit to loss ratio. And again, I like to build my positions in increments, and I'll position myself in a stock or an option by purchasing a 1/4 position or a 1/3 position at a time. And when I do that, I'll only add to my position if the stock is higher than my previous purchase price, and that's a sign that the position's working in my favor. I won't buy another increment if the stock is lower, because I don't like to average down. So you want to buy in increments only if the stock is higher than your last purchase, and that shows you that the trade has been successful. And also want to exit trades in increments. Generally, you could exit a third of your position if you have a 20 to 30% profit, a third of your position with a 40 to 50% profit. Now we're talking about stocks right now, and then hold the third of your position until a trend reversal. And you'll see in the inner circle we do exit trades in increments. If we have a good profit in a stock or option, you can see in the closed trade results that we will exit in increments, usually 1/3 increments, to lock in our profits. Now, another important concept is you want to limit your positions in a stock or an option to 10% or less of your total portfolio. That way, if you have a large loss in any given position, it won't hurt your portfolio that bad. If you have 20 stocks in your portfolio, or you have 10 stocks and 10 options, and one of those stocks or options has 100% loss, that would only create a 5% loss in your total portfolio. So that's an important concept also, is to try to limit your positions in any given stock or option to 10% or less of your portfolio. And that way you reduce your risk of a large loss in any given stock that could really bring down your portfolio. If you only had 3 stocks in your portfolio and you had a large loss in one, then that would create a large loss in your portfolio also. And also you want to invest in different industries or sectors for diversification. I mean, this is just common sense. You don't want to put all your eggs in one basket. You don't want to have all your stocks or options in one industry or sector in case that goes into a big sell-off. So that's just common sense. Here's a snapshot of one of my stock portfolios, and in this portfolio, I do have 10 stocks in this portfolio. So that spreads out the risk, and a large loss in any given stock wouldn't hurt the portfolio that bad if I have 10 stocks in the portfolio. Okay, let's talk about buying puts on our stocks to protect the profits. And we do this in the inner circle. We have a married put portfolio, and if we have a profit on a stock that's either in the stock portfolio or the dividend portfolio, a lot of times we'll go ahead and purchase a put option to help protect those profits. And this is one of my favorite strategies, especially for the dividend-paying stocks, because a lot of times the dividends will pay for a big portion of the put option protection. So this is all part of our money management. So here's an example. I purchased 400 shares of Humana. These are my brokerage confirmations here. I purchased 400 shares of Humana at $74.80. I had a profit in that stock, so I wanted to protect those profits. So I bought 4 Humana 90 strike put options. And whenever you buy a 90 strike put option, the value of your stock cannot go below 90. So the the strike of the put option is like a floor for your stock position, and the value of your stock will not go below that strike price. So in this case, there's a 90 strike price. So the stock I bought at 74.80 will not go below 90 while that option is in effect. Okay, and by buying that put option, here's a married put calculator for this trade. Again, buying Humana at 74.80, buying the 90 strike put at 3 points. You can see no matter what happens to the price of Humana, if it goes down 50% or even 100%, I've locked in a 15.7% return on this trade by buying that put option. So buying the puts on our existing stock trades allows us to lock in profits, and at the same time allows us to participate in any further upside potential for the stock. So if Humana continues to go up in price, then my profits continue to increase. So by purchasing the put option, we don't limit our upside potential. And another strategy that we use for our option portfolio, if we purchase an option and we get a profit in that option, a lot of times we'll go ahead and sell a call option against our option purchase, and this creates an option spread, a limited risk option spread. And we'll take a look at the advantages of that here in a second. And here's some brokerage confirmations. This is for MasterCard. I bought the 330 strike call for 23 points. And then about 10 days later, I had a profit in this 330 strike call purchase. I had a profit in it. So about 10 days later, I went ahead and sold a 360 strike call at 20 points. So what I did was three things. I increased the profit potential of this 330 strike call by over 100%. In other words, on the day that I sold this call, I already had an existing profit in the 330 strike call purchase, but by selling this call, I increased this profit potential, the existing profit potential, by over 100%. So I increased my profit potential, and then look at this, I reduced my risk from $2,300 to only $300 because I got $2,000 in cash for the sale of this option. So it reduced this cost basis of this option from $2,300, if we subtract this $2,000, reduced my overall risk by only $300. So I increased my profit potential, I reduced my risk, and it also, by creating a spread, it also allowed me to maintain this position during volatile price swings. Sometimes you can, if you simply own a call option, you'll have a volatile price swing in a stock, and you could get stopped out. So it helps prevent getting stopped out of your option purchase when you sell a call option against your purchase to create a spread. So there's a lot of advantages to doing this. Here's another example. I bought the Apple 345 strike call at $2,817 or $2,817. I had a profit in it. So then 11 days later, I sold the 375 strike call at $2,455. So again, I reduced my overall risk from $2,817 to about $360. I increased the profit potential, the existing profit potential on this 345 strike call purchase, and then it also helped me, it also provided downside protection in case Apple stock dropped in price. I can still maintain this position. So again, when we sell calls to create a spread against an existing option purchase, we increase the profit potential of the option purchase. The option sale provides downside protection, reduces the overall risk, and allows you to maintain your positions during volatile markets. And the spreads can be profitable stock if a stock goes up or down. And again, with the MasterCard, buying the 330 strike call at 23, selling the 360 strike call at 20, it increased the profit potential, the existing profit potential of my option purchase by 106% and reduced my overall risk from $2,300 to $300. And with the Apple spread, I increased the profit potential, the existing profit potential of the 345 strike purchase by 110% and reduced my overall risk from $2,817 to $362. And again, this enabled me to hold the position during volatile price swings. Here's an option spread analysis for the MasterCard spread, and this trade had a 900% profit potential, and even if the stock stays flat, had 900% profit potential, and even if the stock declined 5%, I still had a 570% profit potential. And here's a call option spread analysis for the Apple spread, and this spread had a 728% return potential if the stock stayed flat, or if it goes up, or if it goes down 10%, I still have a 728% profit potential. So again, the advantages of creating these option spreads over an option purchase is we increase the profit potential, and typically we can increase the profit potential by about 50 to 100% for the option purchase. Of course, the option sale provides downside protection in case the underlying stock or ETF declines in price, and reduces the overall risk. We saw in the Apple spread example, my overall risk went from $2,817 to $362. So that's quite a reduction in risk. It allowed me to maintain my position during volatile markets, and the spread can be profitable if the stock goes up or down. And we saw an example of that with the call option spread analysis. So overall, there's a lot of benefits in selling a call option against an existing option purchase, and it's all part of our money management guidelines. Here's a snapshot of the option spread portfolio with $120,000 in open trade profits, average return of 127%. And a lot of these spreads were spreads that were initiated by selling a call option with a higher strike price at a later date against an existing option purchase. So you'll see periodically when we have a profit in an option purchase, you'll see at a later date, I'll put out a recommendation to sell a call option against that option to help protect the profits and also increase our profit potential. So we'll do that periodically, and you'll get an email alert when we do that. And also I wanted to mention we have a lot of January 2012 options. So we've been rolling over these January 2012 options for several months now. We had them in the married put portfolio, we had them in the option portfolio, the option spread, and the buy right portfolio. So we've been slowly rolling over these January options into later months. And I just wanted to mention that that's an opportunity for newer members. If you don't have the existing trade, when we put out the rollover recommendation, that's an opportunity to get in on that trade. And I'll usually list for an option spread, I'll list the profit potential for the option spread if you just purchase it at current prices and you're not rolling over from a previous position. So I'll usually mention the profit potential on that. But that's a way for newer members to get in on the option trades when we do a rollover. Now, the same principles apply for buy right trades. If we have a stock position in either the stock portfolio or the dividend portfolio, and we have a profit on that stock, a lot of times we'll sell a call option against our stock position, and similar to the option spreads, by selling a call option against your stock or ETF, again, it increases the profit potential, provides downside protection for your stock, reduces the risk of your trade, because whenever you sell a call option, of course, the premium for that option is cash, and it goes right into your brokerage account. So reduces the risk of your stock purchase and also increases the profit potential, and allows you to maintain your stock position during volatile price swings. And here's an example of some buy right trades that we took. This is for the gold ETF, Chevron, Chart Industries, United Health, and DuPont. And with these buy right trades, what we did was we had an existing profit in the stock or the ETF, and then at a later date we sold a call option to help protect those profits. And by doing that, again, we increased the profit potential of the stock purchase and provided downside protection. So these are examples of existing stock positions that we had in the various portfolios, and we sold a call option at a later date to help protect those profits. And we have a lot of, in the buy right portfolio also, we have a lot of January 2012 buy right trades. So again, that's when we roll those over into later months, that's an opportunity for newer members to get in on that trade by simply purchasing the stock at the current price and selling a call option. Here's an example of one of the trades. This is for Chart Industries. We bought the stock at $38, and then we sold the March 55 strike call at $8.80. And I plugged this into the buy right analysis, bought the stock at 38, sold the 55 strike call at 8.80, and we can see that if this trade, if the stock just stays flat at 38, we have a 30% profit on this trade. If the stock goes up 50%, we have an 88% return, and if the stock goes down 15%, we have a 10% trade. So again, this is like the option spreads. This trade will profit even if the stock goes down. So when we sold this 55 strike call at 8.80, we reduced this cost basis of the stock by 8.80 points because we got cash for that. We gave $880 cash for selling that call. So we reduce our overall risk, increase the profit potential, and as you can see, provide downside protection if the stock goes down in price. So again, that's all part of the money management guidelines that we use in the inner circle, and as a result, we've been able to produce consistent monthly returns. And again, this is the monthly closed trade profits for the inner circle advisory. So you can see it's been consistently profitable every month. So these money management guidelines are a big part in helping us maintain the consistent profits of the advisory service. So I just wanted to explain these to members just so they have a general idea of what we're trying to do and the overall goal of our money management guidelines that we use in the advisory service. So that concludes my presentation, and I'd like to take any questions if people have questions. And Adrian, I'm trying to show the question box here. Let me see if I can get that up.
It's on the drop down on the top, Chuck.
Okay.
Or I've copied everything also into the chat, so you're redundant between the chat and the question section.
Oh, okay. Okay. Okay, here's a question from Jim. Hi, Chuck and Adrian. I noticed that it may take a year or so to really get a full boat of trades. Do you plan on providing a service for a long time? And Jim, yes, I've had an advisory service for 12 years now, so I plan on maintaining this for at least another 12 years. So yeah, to answer your question, yes, this is a long-term program, and I'll be doing this for a long time. And I also have my son involved now, and he's helping me with trade recommendations and doing research, and overall he's learning the whole advisory service business on how to keep the advisories profitable. Okay, here's a question. It seems that converting to spread is much better return than initiating a spread at the same time. And yes, that's true. If you buy a call and sell a call simultaneously in the same time, you create a spread, but your overall return potential will be lower than if you had an existing profit in an option and then sold an option at a later date. That will always be the case. It's not to say that we don't do the simultaneous purchase, because we do. We have one recently for Google and for Chipotle that are working out pretty good. And with both of those spreads, we bought a call and sold a call simultaneously. So we do it both ways. Sometimes we initiate the spread by buying a call and selling a call simultaneously. And sometimes we will initiate a spread at a later date when we already have a profit in an existing option purchase. Okay. Could walk through the closing out of positions. I'm not really sure what you're referring to. Walk through closing out positions. When we close out a position, if it's a stock, we just simply say, sell the stock. If it's an option, the trade recommendation will say sell to close. And when you sell to close, that closes out an option position. If we have an option spread, the way you close out an option spread is you sell to close the long option and you buy to close the short option, and that will close out both the long and short option. Okay, here's a question, Chuck. Sometimes you will list that a person can get into a trade if they did not buy before. Other times you don't. Should we newcomers still try to get in on a trade? And normally what I do is for when we're rolling over an option spread, I'll calculate the potential for that, the new spread, so that newer members, if they don't own the existing spread and they're not rolling over, they can purchase the new spread, and I'll put the usually put the profit potential if you're just initiating the spread for the first time based on the current prices. And with the buy right rollovers, I leave that up to the members because some of those trades take a lot more money than the option spreads. So it just depends on how big your account is, and you can easily calculate the potential for a buy right trade by using the buy right calculator. And if you have enough funds in your account and you have a large account, then you can certainly take the buy right rollover trades. But I normally don't list them because that takes a lot more money than rolling over an option spread. And most members can take the option spreads because they are lower cost. Okay, here's a question from Stephen. Do you time your rollovers based on Keltner channels or just when current options are ready to expire? Usually it's just when the options are ready to expire. Okay, how does one take advantage if I have a smaller account? And I recommend you watch the Getting Started webinar or the Getting Started video. And in that Getting Started video, I list various model accounts based on your account size for $5,000 accounts, 10,000, 15, 20, etc. So I recommend you look at the Getting Started video. Okay, what is the website that shows all the various systems that are available? I'm not sure what you mean by available systems and website. Normally, I use stockcharts.com if I want to check the price trend or the on-balance volume, or if a stock is making a new 52-week high. So I use stockcharts.com a lot for a lot of the analysis. Okay, here's a question on spread trades. Do you ever buy back the short option if the option becomes cheaper than you sold it, and then reselling it when the stock or ETF goes higher? Yeah, sometimes we in the past we have bought back short options if they've gone down in price and they're not worth much. We'll go ahead and either roll that trade over, or we'll buy back that short option and sell another option. So we do that periodically. Here's a question from Bob. How should a newbie participate? And again, I would look at the Getting Started video as a start and just get a feel for the advisory service. And there's some model portfolios listed in there based on account size. Do you recommend put spreads for credit for monthly income? No, I only do the debit spreads. I've had the most success with the debit spreads. So I don't do credit spreads. They're riskier. So, okay, I think that's it on the questions, and I want to thank everybody for participating, and we'll have another webinar in 2 weeks, and we'll go over another inner circle strategy. So, again, thanks for participating, and I will see you in 2 weeks. Thank you, everybody.